Gabriela, where are central banks creating bubbles?
So we do, one of the areas we focus a lot on is the rise in corporate credit that's happened in the U.S. during this entire cycle. Now, by no means in and of itself is that big enough to be a bubble on its own. But if central banks maintain rates low, that encourages even more corporate borrowing. Eventually, we wonder, eventually when there is a slowdown, right, that will exacerbate the slowdown.
Okay, but we're year 42 in a bull market. I'm kidding, folks. It's not year 42. It's only like year 38.
Does feel.
It just goes on forever. Market goes down, step in and buy. It's dangerous, isn't it? I mean, we've been here before.
And we do think ultimately this is still a low recession probability kind of world.
And lesser than 8 months ago, for sure.
And lesser than 8 months ago when it felt like there was a very real chance that eventually the Fed could step on the brakes. So that's welcome. We do want some exposure to risk, some offense in portfolios. But by no means should we close our eyes and go all in very overweight high yield bonds or equities. We need to start playing a little bit more defense.
You mentioned share buybacks before. I mean, does that gravy train continue? I was stunned by your 2% number. You're giving me a January 1st 2% return off share buybacks on SPX?
And when we mention this idea of having a better balance between the growth style or tech and the value style, we focus on two sectors in particular, both energy and financials, that are a really good income story based on dividends as well as buybacks. So focusing on that income over capital appreciation story here, as we're seeing some of the limits of the central bank story starting to come to the forefront.